If you're looking for intellectual consistency in this market, you're not going to find it. And if you want intellectual consistency, I think that's you're an aspiring international investor.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I am joined as always by the brain trust himself, Mr. Chase Taylor. And if my background looks a little bit different, because it is, I'm doing this from a hotel in Puerto. That's how committed to markets and the dots I am, man. That, and I'm on forced low activity from the doctor. Little stem cell treatment here on the old back. So I'm hoping my golf game bears the it bears the benefits from that. So anyway, I not a lot going on today, but it was interesting to me nonetheless. Before we get into that, why don't you give us a rundown on where we finished up on the indexes?
Yeah, we got some good trade headlines that kind of push us up towards the end. S&P closed up 0.55, Q's 0.66, small caps 0.54, equal weight up 0.5, Mag 7 up 1.37, all world ex-US up 0.33, so all things up. Oil closed down about 0.6. You had gold down about 0.2, same for silver, platinum up 0.5%. You had the dollar essentially flat and bond yields essentially flat. So kind of a quiet day out there. Front month VIX futures closed down another 1%. You're at 18.1 now on front month VIX.
Yeah, some interesting things. Two things. One of the things I have learned, and it hasn't been a fun lesson, but one of the things I've learned is when you see a market rallying fairly consistently and there doesn't appear to be a reason. Um, like I'm not saying that the reason shows up later, but I'm saying that that's oftentimes a market you don't want to step in front of. And I think that you could very much chalk this up as being that kind of market. I think it is laughable, the valuations people are willing to pay for this crap. I think that the amount of ridiculous stocks getting to ridiculous levels continues to blow my mind. But when you continue to see a market moving up like this, I'll tell you right now, now we could be very quickly to a period or a point where I would like to press on some shorts and take a shot to the short side, but not for right now. Um, and it's funny to me how these things can get defended too. I've seen it all over Twitter. Yeah, but this doesn't make any sense, and oh, this is too expensive, and, and I'm just kind of like, where have you been?
Yeah.
Like when has that mattered? I didn't hear you screaming that at the end of 2021 when we were trading at 35 times earnings. So, I just think, you've got Bitcoin at 108,000. I mean, look around you, right? You got people burning down LA because they're getting thrown out of the country, but waving Mexican flags. If you're looking for intellectual consistency in this market, you're not going to find it. And if you want intellectual consistency, I think that's you're an aspiring international investor, right? You're not going to find it in these markets. But I don't know what your thoughts are. You and I did not get a chance to preview this before we went on, but this is not a market that I want to be standing in the way of right now.
Yeah, and I think people view this as a contradiction. I'll use the Ayn Rand quote: "Contradictions do not exist. Whenever you think you're facing a contradiction, check your premises. You'll find that one of them is wrong." And this is where I think you go back to passive and the machines, all the systematic stuff. People that are struggling to figure out what's going on. Like machines have an on and off switch. Right now it's on. So other than major exogenous stuff, the market is going to go up. Now, as we talked about in our meeting today, like you're starting to maybe see some potential catalysts for that switch to go back to off. But until you get one of those, like You see CTA still have to buy, vol control still has to buy. Obviously, passive's going to buy. So I think
Yeah,
that's the
I mean, look,
story. Is that you get that window of vulnerability.
yeah, and I think that front and center, I mean, if you want to, like, I really don't care what your long-term outlook is on the market or a stock. If you want to get what I'm talking about, and I think what you're talking about as well, go explain the $100 increase in Tesla shares from after it got obliterated in those court. Like, you can't make any sense. Oh, because Trump said, guys, it's an automobile manufacturer who's getting absolutely destroyed, trading at 180 times earnings and rallying like it stole something. Okay, like if that doesn't tell you, yes, is it irritating? Yeah. Yeah, especially for a guy like me that's a fundamental investor. But when you see that happening, you know, I know you and I have both learned this lesson. Like, don't cry about getting burned on a stock because the stock keeps going up irrationally, right? Just because you pull out a short position doesn't mean all of a sudden the thing's going to start to make sense, And now I do think that you're entering, I think not too distant, especially in Tesla's case, we might be there now, a spot where you can try some shorts and try to go after it a little bit here. But, again, you've got a market that just wants to ignore everything. You made a really good point on our investment call earlier today, talking about how all trade risks have been priced out of this market, all of them. And that's just not reality. And I think that when I look at the VIX where it's at, um, timing on these things is really difficult, but I think the parameters you and I set was like, June 15th, June 20th. I think you need to start kind of looking over your shoulder a little bit. Um, and nothing crazy, but maybe some protection, looking for things to happen in those first 10 days of July, because as you pointed out, that's when the tariffs roll off. And like I said, this market has all, this market's assuming a whole lot of things right now that there just really isn't any evidence of.
Yeah, and that's where like these opportunities come is when the market prices something in that just doesn't really make that much sense. That's where you find these opportunities. And to your point from our call today, like I'll share with the people what I shared, and that is basically I'm finding that the market, and honestly everyone I know at this point virtually has convinced themselves that, oh, we're just going to do 10% across the board tariffs. That'll be about it. Like maybe China gets a little bit more, but everyone else is going to get their 10 and we're just going to move on. And I clearly, to me, that's what the market more or less believes. But then July 8th and 9th, we have, all the smaller countries on the 8th. It's basically everyone ex China and Europe. And then on the 9th, you have Europe. And obviously the China stuff's ongoing and at 30% anyway. So even if that doesn't change, it's still a lot. So all you need for the market to get upset is for the 8th and 9th to come and for it to not be 10. So like, let's say there's a handful of countries, maybe countries in Southeast Asia, they get stuck at 10, 20, 30, 40 or something, even if it's just for negotiating again. Like, but the point being, the market viewed 90-day pause as it's over forever. And that may not be the case. That's basically the point in a nutshell.
No, I could totally agree. And here's the funny part to me, right? Now it's very slightly, but the S&P and NASDAQ are both slightly green on the year, right? Um, Name me market, like, if you were to announce an international corporate tax of 10%, right, what would the market reaction be?
Freak out. Yeah, it's true.
Right. So what is difference? So we're all like, oh, it's just 10%. You're looking at everybody going, guys, how does that not affect your profit outlooks? How does that not affect your valuation outlooks? But I say that not to fade the move. I say it to illustrate and highlight the point that I was making, which is you're playing the game in front of you, not the game you want it to be. And none of it makes any sense, right? I mean, I honestly believe, and I truly believe this. I think there have been times where it's been more valuable. I think that this is the most price insensitive market, both to upsides and downsides, that I've ever seen. Meaning, I don't think I've ever seen the number of securities that I think have, and on both, to be fair, on both sides, that have valuations that are indefensible when you compare it to the underlying fundamentals. And, I'm not saying that that's not dangerous. Um, I'm just saying, I think one of the biggest mistakes, and I know this because I've made it, is getting caught up in the irrationality of it, getting caught up in the idiocy of it all, and not paying proper respect, which is this is a perpetual motion machine. The only way this thing quote unquote collapses or goes in on itself is if it quits getting fed capital. And I think a really good way to look at it being fed capital is look at deficits. It's really hard for me. Do I see a scenario where you could have a big market drop and a big nasty recession? Yeah, but I don't think it would be. It's hard for me to envision that particular type of scene without a significant pullback in deficits of some kind, right? Because I mean, just look at it, right? This year, whatever the economy doesn't do, we're throwing an additional $500 billion of government spending at the picture, right? I mean, so you know, if that staves off recession, if the unemployment rate doesn't go up, the perpetual motion machine is in motion. And we already have acknowledged, and we've already provided examples of, yeah, values markets are pricing mechanisms or price discovery mechanisms. That's no longer the case.
Yeah, exactly.
Sorry.
Or like Mike Green, like obviously we talked about him in the passive stuff a lot, but like he had, he's like he says, this used to be like a way to allocate capital. That was like kind of what it did, and that's just not really the case anymore. It's just really just a flows and liquidity game. And to your point about deficits, John Thune, the Senate Majority Leader today, said that that the Senate would definitely deliver on the campaign promises for tips, tax exempt tips, overtime pay, Social Security, and auto loan interest. So you're going to get all of those things coming down, which obviously going to make the deficit not exactly shrink. So the deficits are kind of clearly here to stay, and it drives a lot. Like it's so hard to have any significant downside in the economy or risk assets with that much just being pumped in.
Well, the interesting thing, and this is what I'm really looking forward to talking to Brent about. The really interesting thing is I think that you're starting to see, and I'll certainly defer to him, but I think you're really starting to see, or at least seeing what it might look like, liquidity getting sucked out of the U.S. and going to other markets, right?
Yeah.
So,
That everyone else doing stimulus, that fiscal side is it. I mean, they literally have to get money back just to do that. So.
right. And then, like I said, and you're hearing it, you're seeing the signs of it, you see it in relative performance, kind of like we thought. I think that this has served as a wake up call for a lot of asset managers around the world that have looked around and said, all right, and what it appears to me, and I was going to say this, if you were to ask me what I think I've been seeing over the last 3 to 4 months, I think what I've been seeing is distribution, for lack of a better term. It feels to me like international investors are selling rips and reallocating abroad, right? Not dumping wholesale, not trying to, nothing, yeah, not panic worthy, but, you just look at some of the names, and now watch, I say this, it'll be limit up tomorrow, but just like look at Apple, like just look at the chart, like it just feels like somebody's like, hey, every time we can sell between 205 to 210, just take some more off the table. You know what I mean? It keeps trying to pop up, just gets sold. When you, and here's the thing I don't think is being appreciated. You know, I don't think I don't think, I know you can go look at their portfolios. I don't think most asset managers around the world are positioned that differently than most retail stock traders here in the US.
No.
I think they got outsized positions in the FANGs. I know just show me their performance and I'll tell you exactly if they have outsized positions in the FANGs. Because you and I both know that's been the only game in town. So yeah, I think that, and from where I sit today, looking at the map that I'm seeing today, again, I don't think it spells doom and gloom for U.S. markets, but I do think it spells sort of a death from 1,000 cuts scenarios, or scenario that could be facing a lot of investors over the longer run who have built their spending and retirement spending and vacationing habits around the fact that the S&P, it's a birthright, it goes up 15 to 20% a year. I do honestly believe that that's over. Now, am I going to bet the farm on that? Does that mean that I'm short US? No. Again, in this environment, I don't. I think this is the quintessential version of a strong convictions, loosely held kind of environment. You got to just you got to be ready to tack at any moment and roll with it. And ideology, I think, will kill you.
Yeah, I think we're basically still grasping at the the real side effects, the real downstream impacts of some of these things we just haven't dealt with in really our lives. This is stuff you read about in the book, in the history books. So to see, you know, some of the fractions that are like broken between like us and Europe a little bit, and like just some of the stuff like reallocation of trade, reallocation of capital. This this is the kind of thing that you've been able to just ignore for the last 30, 40 years, and now all of a sudden, like you read some of the things that you're hearing from officials in the European Union, not just the EU itself, but member state countries or out of Asia. Like it just becomes clear, like they want some capital back. They need capital for their own reasons, and it's not just like a U.S. driven thing. Like Australia wants a little bit more, autonomy away from us, a little bit more away from China. Europe wants the same. It's like everyone kind of wants to do their own thing on a scale they haven't wanted to do in a long time. And if you want to do your own thing, you need your own capital. And
Well, and these to me are the turning points you look at, and I just believe that this is too big of a turning point to not have an impact, and that's why I think the status quo has already changed, and I think people are behind the eight ball on it. And being down here now, granted, this has always been somewhat the case, but being down here in Puerto Vallarta. First of all, I haven't been here since before my first daughter was born. Puerto Vallarta. I've been to Mexico. The This place has blown up, like blown up, and in a good way. The amount of great restaurants down here, the development. I'm staying in a gated community, guarded, gated, super safe area, and you can get 4 bedrooms, 4.5 baths on the private golf course, 3,500, 4,000 square feet, infinity edge pool, right? Whole shoot match, 3 car garage. You can get that for 1.2 mil and a country club to a gorgeous country club, workout facilities, tennis clubs, everything for $300 a month. And the reason I bring that up is, what have we talked about, right? The biggest pile of capital in the world is the baby boomers' retirement portfolios, right? Um, I don't see anything, despite tough choices ahead. Well, not nothing, but I see a lot of tough choices ahead for America. I don't think any of them point to lower costs of living. Um, and when you're looking at all these different things, it's like I said, I honestly think that the U.S. markets are going to do an interpretation of what the rest of the world did over the last 15 years. I'm not saying it's going to happen for 15 years. I just think that they're going to end up being like a lending pile, like almost the World Bank. So the sovereigns are bringing money away too, but I think there's a lot of U.S. money that's leaving, and not because it thinks that the U.S. is going to get burnt down, not like is it just because, like I said, cost of living, man, you can't find that anywhere in the U.S. I mean, 1.2. I mean that, yeah, it gets you like a flop house in Seattle, right? And $300 a month is like that's like an Americano at Starbucks every other day.
yeah, you can find it, but
You know, so,
not somewhere you really want to live.
Yeah, not Oceanside in a private club and it's just kind of eye-opening. And like I said, we've all known that these places of the world have been cheaper, but they're getting far more Americanized. They're getting far more attractive. There's a big focus on security. And I just think, yeah, and I think a lot of people are just gonna, another thing I was talking to another businessman. They are in the process right now of launching a bank in Puerto Rico, and the reason they want to launch a bank in Puerto Rico is to take advantage of Puerto Rico's tax deal, right? Where you pay 4%. You have to bank there. Well, the problem is these banks aren't exactly JP Morgan, right? So there's a significant risk there. what they need is they need a westernized bank to come in there that's run like a US bank. You know what I mean? And so, anyway, he was telling me that they're already in the process of doing that because people migrating to Puerto Rico is so prevalent.
That's a question
And
for
they just
Brent.
anticipate. Yeah, that's another great question to run by Brent. Yeah, I know he and Cuppy have both moved down there. Um, but I just look at the world today, and where for the last 15 years, as frustrating was it as it was at times, I think that all signs everywhere and always pointed to America, right? Send your money there for what you're dealing with. I look at the world today and I don't see America being on fire, but I just see all of those. The impetus now is to get money out. I mean, you've got internally baby boomers, like I was saying, for cost of living reasons, trade uncertainty, bipolar, powers, all the different stuff. And I'll just put it this way: I don't think that we're just going to cruise through here, averaging a 30 to 40 CAPE ratio here in the U.S. for the next 10 to 15 years. I don't see it.
Yeah, for sure. And even if we just kind of go sideways while earnings continue to get better while the rest of the world goes up, I mean that obviously that has way more power with a smaller trade deficit, smaller budget deficit. But even if we, you know, even if the rest of the world just needs their money back, regardless of trade, they just want their money back. 10% of it or whatever, like that could be enough to have a big impact there.
Yeah. Hey, a question I wanted to ask you. This guy on Twitter, I thought, that posted an interesting argument, and it's one that we've discussed. It didn't catch me off guard, but it was an interesting discussion that I've been kind of toying around in my head with since I read it this morning. Um, I would say an accomplished, incredible trader on Twitter was putting out information in his newsletter saying that he thought it was the time to go long duration. Um, from a sentiment and positioning standpoint, um, I love the trade, and I have been magnetically attracted to that trade ever since people started talking about 8% 30 years. Right. Having said that, it feels like a very at this point to me, it feels like it has a very concave outcome curve. Right. Meaning, I don't see the upside to it. It 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 looks like the kind of setup that I purposefully try to avoid. Not at all saying it could not be correct. What are your thoughts on it? You were a little bit more open to it on the face of it, but you and I didn't get a chance to discuss.
So for me, obviously there are times you can tactically do well being long duration, but longer term, kind of strategically, every all these big forces we just talked about are terrible for duration. So to me, just on a personal level, I would just never for the next probably 10, 20 years, I would not ever just be long duration, me personally. Um, because whatever is going to make duration rally will also make the front end rally. And I get that there's a little more leverage out on the long end. Like, let's say you have a recession, you might make some more being long duration than you would, being long the short end. And I get that. But I think if anything, the last 4 years have taught us is like, it's hard to have a recession and the economy goes to these like tactical periods where like the economy pulls back a little bit and you're like, oh, here it comes. And the next thing you're 4% growth and everything's fine again. So like, for me, it's a no. And if I think we're going to have problems, I would rather just own the short end.
I would just one thing I was going to say is if that's your outlook, just short equities.
Right. Or yeah, exactly. Right.
Yeah, or be long vol. I mean, I just think that there are so many other ways that have so much more convexity. And like I said, the reason I wanted to discuss it because we've discussed it internally, and this guy's a thoughtful, smart trader. That's what makes a market.
Right.
But it just feels one of the way I was thinking about it, Chase, is I was sitting there going, do I think that I could make more money being long duration over the next 6 months than owning gold or gold miners? I think it's entirely possible. Am I willing to sell some of my gold or gold miners to buy duration? Not a chance.
And from a portfolio perspective, that's honestly the best way to look at it, right? Exactly what you just said.
Yeah.
It's honestly, it's
Yeah.
largely the same, like kind of trade. So except that, if yields blow out to the upside, like in some ways that would be great for gold. So like yeah, I don't. It's not for me.
Well, yeah, play out that scenario. I think if yields blow out to the upside and U.S. equities get thrashed, I think you'll see gold just take off like a rocket.
Right.
Right. But this goes back to our point. And that's why when I get into environments like this, I think that you can be way too cute. And I would honestly make the assertion that one of the reasons that we're having the year that we've had is because we've managed to not be too cute, right? Just kind of taking what's in front of us and doing what's obvious. Um, and I think getting too cute and trading around this in this current environment, I think it's I think it's dangerous, man. And the reason I think it's dangerous is I think something like gold could get away from you in a hurry. I think yields could move against you a lot in a hurry. Um, and I just think in times like these, at least from my experience, and then from the words of people that have had a lot more experience than I do, I think you've got to stick with your highest conviction plays, and you've got to be looking to manage risk constantly, and stay nimble. Right? Don't. This is an environment to date. I don't think it's an environment to marry.
Yeah, and even if you think yields are going to are going to go down a lot, go buy some home builders or something. And if you think there's going
It's a
to
good point.
yeah, and if you think there's going to be a recession, you could probably sell the dollar. Like, I don't know. It feels like there's a lot of other things to do adjacent to that trade. I feel weird about this one because like there's so many things where like I'm usually willing to rent anything. Like, don't care. I'll
Mhm.
write it for a little bit, but for whatever reason, Treasuries like the long end just feels so dark to me, and like the potential problems there, they just strike me as too big to rent for any period of time that matters. That's for sure.
You know what analogy I was thinking of? I feel like it's like the inverse of not believing the social media hype in 2011 and 2012 and doubling down on gold miners. You know what I mean? Like, so I feel like that's the equivalent trade today, where you're like, hey, you could be right, but one of the things we keep talking about is that analogy of, who would you rather fight, Steve Urkel or Mike Tyson? And I think a lot of people are like energetically jumping in the ring saying, give me Tyson. And I'm like, nah, I'll stick with Urkel.
And
Thank you very
I will
much.
say, like, to your earlier point though, like on the sentiment side, like there's an article every day about how the bond market's screwed and stuff. And like, even though I agree with those, like that is what makes you feel like the setup for like, oh, we might just gap down 50 bips in a month or something. Like feels possible, but like tomorrow we get the CPI print. Expected to come in zero point 0.2 and zero point 0.3 on core. It could easily come in lower. That'd be like the exact scenario where you could see yields really come down and like the odds of Fed rate cuts popping higher, and like so this trade could absolutely work. But it's one where like for me, if I was in it, if I was up 10%, I'd be like, oh my gosh, I just want to take this win and get the heck out of here. And whenever you feel that way,
Yeah.
there's no point in doing the trade.
Yep. Because you're going to have zero conviction in it too. And to me, it feels like the quintessential picking up nickels in front of a steamroller.
Yeah.
And I wish him and everybody else doing it all the best of luck, with full acknowledgement they could be 100% right. Again, though, I just look at everything together, and most importantly, like I was saying earlier, the opportunity cost, because you can't forget about that. Um, I think that we have what is somewhat of a generational setup in precious metals and natural resources that will take several years to play out. I just know that you and I have talked about this before, but I think it's an important exercise to deploy when you're allocating capital. And it kind of sounds weird, but think about, like, if 10 years from now you are wrong, which side can you more easily live with being wrong, right? Um, I can easily live with missing out on a drop in yields.
Right.
Right? Like, no problem. Okay, what I cannot miss out is what I believe is happening in gold and miners writ large and in precious metals. Can't do it. That looks just like it looks like one of the only fat pitches I see out there right now, quite honestly. And one of the reasons I think it's a fat pitch, Chase, is geopolitically what we're facing and the choices that so many governments are going to have to be facing and dealing with. We're at a point where I don't think lip service is going to work against a lot of the issues we face. I think it's going to be hard choices and hard realities is my anticipation.
Yeah, I agree.
Do you have anything else, man?
One,
Data? Anything else you saw?
one all we had today data wise was small business optimism, which was higher than expected, pretty solid. One interesting thing from the day, which is frankly weird to me, is that Bloomberg came out with a piece saying that the Scott Besson is actually emerging as a major candidate for Fed chair, and I just want to say
Mm-hmm.
how unbelievably stupid that would be, because it's become clear that like running him out in the media to kind of soothe investors every time something interesting happens has been a pretty huge asset, and he's literally filling the airwaves every single day. So if you removed him from the administration and shoved him in a much more quiet role at the Fed where he gets to touch policy, maybe twice a year or something like with rates, that just seems crazy to me. Like you need him to talk to the markets every day on the TV. Plus, I don't think that guy's a shoe-in to just roll over and slash rates for President Trump. I think he would do what he probably thought was right. And I think Trump needs a person that's going to fight to slash rates for him because that's what he wants. So that I just thought that was really weird. Didn't make sense to me. And I don't think that's legit. I don't think he'll be a serious candidate in the end, but interesting news.
Here's something that I've been thinking a little bit about. Um, I would be very surprised if Besson did not have a similar outlook on rates and the Fed cutting rates right now that you and I share. I'd be very
And the
surprised
guy's been a
if
macro
that
trader
wasn't the case,
for a decade, so it'd be weird if he didn't.
and very successful at it. Yeah. Um, so then when I listen to Trump, part of me wonders if his constant talking about cutting rates isn't just about kind of like we're getting to a trade deal with China like 2.0, right? Like just saying it. I have a hard time believing Besson hasn't explained that to Trump.
Oh, clearly he has, and if you go back a few months, remember so Trump was saying like, oh, we need to cut rates, and then Besson was like, hey, stop saying that. Did you notice he stopped saying that?
Yeah.
And
Yeah.
he stopped saying it for like a month, and then he went right back. Now he's calling for a 1% cut. So like he's even up in the ante. Jim Bianco had
Well, and then he,
Jim Bianco had an interesting tidbit that I recently heard that. So according to him, what he had heard was that back in 2018, when Europe pushed into negative rates, someone told Trump about that, and Trump was like, "What do you mean? Like, how's that work?" And they explained it, and he was like, Well, we need to do that. Like, let's do that." And then he's like, "That sounds great," and went to Powell and was like, "Yeah, we need negative rates." And Powell's like, "Yeah, I don't really believe in that. We're not doing that." And like that was the moment he turned against Powell and like has hated him since. Because remember, he he's the one that put him in. So I think he's dead serious that he really wants rates low. Now, would he want everything that came with it if they did that and you got some nasty side effects like on the long end or whatever? Like, of course not. But at some point, we're gonna have to do it for no other reason than it helps buy time on the deficit. But that's that fiscal.
Here's the other thing, and I don't want to be a downer when I say this, but when you look at the stuff that's going on in California right now, um, let's keep in mind that we have unemployment at 4% and the S&P 500 effectively at record highs, trading at 30 times earnings. What do things look like with unemployment at 7, 8%? With the S&P, God forbid, 30% off its highs. Uh,
to go a different direction with that, something that's really worth thinking about moving forward. That's not getting enough attention, I don't think, is obviously these protest riots they came from essentially immigration policy, and you mentioned 4% unemployment, so we're essentially at full employment. A decent part of our GDP growth for the last decade has just been we added human beings, right? That's a big part of GDP. If we go from adding human beings to being flat to even negative from deporting people, like at full employment, like you might put serious pressure back higher on wages, which clearly is very inflationary. Um, so a very underappreciated macro variable, more for like 2026 and on, is if you really do deport a lot of people, you might put serious wage pressures on, which puts a lot of pressure on the Fed to frankly raise rates again. So that whole thing could get very interesting.
Well, and this goes to the point about that I've made before, and you've said it before too, which is this is where, and again, I don't want to keep looking backwards, but this is where I get so irritated at modern economists thinking that they can run economies in bubble stages all the time. Right? Like whenever you listen to their comps regarding about what their economic goals are, and you look at when those conditions have existed at any point over the last 25 years, it was always peak cycle, right? And so this trying to memorialize or make evergreen peak cyclic or peak cyclicality in terms of economic data, GDP, and all that other kind of stuff, it's absolute insanity. And to not accept, because now you're in a situation where policy wise, you need a general recession. You know what I mean? Like policy wise, you and I have been saying this for a long time. You need a general recession combined with some fiscal restraint, a long term plan to deal with things. But you've got a populace so ginned up on the R word and that things can't go down anymore. Like we've said, I understand, you know, the big, beautiful bill frustrates me and does not address any of the fiscal problems, especially debt problems. But do I understand it? Yeah. Would I understand it if it was Biden putting the same bill out there? Yeah. And the reason why, they're all looking at the same data, right? Like meaning you want to get, they're still kicking cans, man. They still, and I throw Trump in this mix too. Everybody still believes the debt issue is going to be somebody else's problem. And I don't think that's the case, man. I feel like we hear it knocking on the door.
Yeah, I mean, for the first time, really in a generation at least, like, the bond market and the currency are showing at least signs of like, hey, you're starting to get to the levels that aren't particularly comfortable. And it's easy, like we're living in this, so it's easy. Like we look at it every day. It's easy to get kind of numb to it. But running 7-8% deficits in peacetime, while at full employment, while growing the economy 2 to 5%, like that's hardcore. Like that's it's and it's there's no easy answer for making it better. So
No, and I'll just tell you right now, guys, there is no comp to it. There is no period of fiscal profligacy that even comes close to masking this. And don't throw to me, oh, well, after the end of World War II, you and I have talked about that, Chase, that you were rebuilding Europe and making your currency the world reserve currency. Not even close to the same, right? You put back in that environment doing those kind. Remember, the other thing is it's a horrible call. Let's say doing the Marshall Plan and doing everything they did post World War II would have ran their deficit to 11%. Guess what impact that would have had on the dollar? None. Because everybody had to use it. Everybody understood what was going on in the world. They were only going to use the dollar in trade. They were going to support the dollar. It's a horrible comp. We have never lived through such profligacy in the history of this country. And I don't know what scares me, just the straight up levels of it, or the fact that the economy is completely addicted. And that's the other thing. I don't think that on the right, when I sit there and listen to Kennedy talk, I love Kennedy. I love, the senator I'm talking about, this comes out there. Yeah, from Louisiana. Love him. The one thing I sit there and listen to him though, I'm like, do you, are like, I'm with you. I agree with what you're saying. Do you understand what horse comes rolling through the front gates if you do that? Right? Because you all are getting kicked out of office.
yeah,
Right? Like, plain and simple.
literally why they won't do it. Yeah.
Yeah. And I think eliminating the cyclicality of that from our economy is, I think it's going to, the Fed will probably get off the hook for it. But and to be fair, it's Congress's fault. The Fed doesn't set the budget. But yeah, man, I mean, these are the situations that guys like you and I were ranting about for the last 15 years, saying, "Hey guys, don't go down this path. There's no way out." And I think that the roaches haven't begun dying yet, but I think some of the roaches are starting to wake up to the fact they're in a roach motel. You know, meaning,
There's at least some sick canaries in the coal mine, right?
oh yeah, yeah. And like I said, you do not have the levers to pull when it goes bad that you did before.
It,
You know, I mean, you're not completely out of moves you can make, but they're restricted.
what's so uncomfortable is you can't we can't really function without a high fiscal deficit, and we can't really function without high asset prices. And those two things are kind of tied together. So at some point, both go down, and they're not easy to rescue. And that's where that's where like things just get kind of problematic. So kind of that medium term, like what worries you? It's just that when we hit that fiscal dominance, like event horizon, where it's like, oh, like there's no way out of this other than pain, and even that pain is less than the pain of not doing anything. But I don't know if that's 2 months, 2 years, 20 years. That's the hard part.
Yep.
What I do
Yeah.
know is
And
they'll
that's,
kick the can until it goes off the cliff.
yeah, yeah, they'll kick the can till there isn't one left. You know what I mean? And then, because then they'll figure out a way to skydive to the bottom of the cliff and they'll start kicking it again. They got to run out of can, man. We used to think they had to run out of road. They got to run out of can. Um, yeah, because the choices they got to make are just not. Yeah, I hate for that to be a depressing one. It's not. Just there are these moments, and I feel like it's kind of incumbent on us to bring that up every so often, just because I think it's so easy to be, you know, I feel like it's so easy to be the fish in the water. Where the one fish, how's the water, and they're like, what water,
Yeah.
right? It's cognitive dissonance, right? We're just all up in it. Um, like for instance, I look at people when I say 7% deficits and I don't see any panic look on their face. And you're like, guys, this is not futuristic. At some point down the road, we got a problem. We got a problem now.
And like, you know, the hard part of that is we talked about like, oh, maybe duration will rally if you go into recession, but the deficit probably blows out to 15% of GDP into recession. So like, why would it rally on that? It might fall apart on that. That's another reason like the trade just doesn't really stand out to me.
Way too many unknowns. And then and I hate to use it because it's not the same thing, but then I turn around and I look at gold and I see kind of the inverse of that, you know? Like if you were to ask me right now, what is the inverse asset to US duration? I'd say gold.
Right. And to kind of go back to the deficit, like what I've been looking for a lot lately is the countries that have tons of fiscal room left that haven't played fast and loose, like the Koreas, the Finland or Germany. Like these people can still pull that lever, and frankly need to. So like we have a
Hmm.
new president and South Korea, and he's like, oh yeah, like we're about to make it rain, and in a place where they never really have done that. So like it stands out.
Well, that brings up an interesting dynamic with the tariffs too, because I think the tariffs actually put another arrow in their quiver as far as why they should,
Right.
attempt fiscal stimulus on their
Seeing it
own.
in Canada
And
already. Yeah.
yeah, and I think that the one thing the Trump administration needs to be very careful of is that tariffs, well, and they certainly are, but I think tariffs could prove to actually be far more harmful than good in a scenario than that. Where um, you start dumping. First of all, go look at their markets, right? Look at their asset price. They're nowhere close to trading at the same levels we are. I think that they have way more slack in their economies than we do, right? So much better potential for growth. Now, Europe, we've been saying that for 2 decades with Europe. So, take that with a big grain of salt. But now they're starting to pull that fiscal lever. And, I think that could precipitate, um, again, and this is one of the things that we point to. I've said it a million times, but when you played this game prior to COVID, you went around the globe and everything came back to deflation. It was like this unending cycle, and the reflexivity just wouldn't end, right? I feel like you're at the mirror image of it today, where it's no matter how you lay the cards out, you keep coming back to these same snags, these same problems. And yeah, tough choices are going to have to be made, and they will delay it as long as possible. But I do think you're at the stage where I think I think markets are not allowed to just sit on the sidelines and twiddle their thumbs like they had the previous 15 years. I think that you've got impetus and reasons to move capital, and I don't see that stopping anytime soon.
Yeah, I think we've been the cleanest dirty shirt for the last 15 years, and that's why we've gotten all the capital. But now when I look around, like, we're eating ribs in our white t-shirt, and the rest of the world's at the laundromat washing their shirts. Like that's the way I got to see it.
Yeah, we look like a 3-year-old that just got out of a barbecue contest.
Yeah.
You know what I mean? Just painted. Anyway, all right, man. Well, do you have anything else to add to that? Or are you good?
Nope, good to go.
All right, you guys, we will be back again tomorrow. Have a wonderful evening. And as always, catch us on YouTube at Know Your Risk Podcast, on Instagram, Twitter. You guys know where to find us. And you're not going to want to miss that interview coming up later this week with Brent Johnson. That's going to be a fun one. But we'll see you then. Have a great night. And we'll actually see you before then. We'll see you tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.